It's been 3 months since I last updated you guys, and I'm not going to lie, it kind of feels like my portfolio has just been printing money the past couple of months. We had a massive 15% sell-off in the overall market. My portfolio went down a ton. Today I want to update you guys on my portfolio, tell you exactly what I've been doing in order to navigate this very strange environment that we find ourselves in. Now, here's a table that goes over exactly what my portfolio holds. You can see what percentage of my portfolio is allocated to a given company, what the previous percentage total was last time I updated you guys. So that was probably 3 months ago-ish. It's been a while. And this last column details the share count change since the last time I updated you guys. Now, what you'll notice immediately is all the red here. I have not bought anything except for cash. Wait, but Alex, don't you always stay fully invested? Yeah, I mean most of the time. And I'll go into exactly why I'm holding 5.6% of my portfolio in cash. You'll notice though, I haven't sold anything, but I also haven't bought anything. There's a few reasons for that, but I'll go into it a little bit later. First of all, let's start with NVIDIA. NVIDIA, once again, holding almost 50% of my portfolio. I love this company. I'm not changing it. CrowdStrike, 20% of my portfolio. And then we go into VGT, which is something VGT was the ETF that I held since I started my portfolio back in January of 2019. It's just grown so much that, and I haven't sold any of it, that it still holds 12.4% of my portfolio. And I'm okay with that. I'm okay with 12.4% being a vastly diversified technology ETF. The rest of these holdings are very small. You've got Visa, Meta, AMD, Alphabet, MasterCard, Apple, and Microsoft, which all combine to maybe about 10% of my total portfolio. Not much. But lastly, let's talk about cash. This is a new row on the holdings list. Normally, I don't have cash in reserve in my portfolio. I like to stay completely fully invested. I don't like having more than 1 or 2% of my portfolio in cash at any one time. Generally, cash is sort of the medium by which I exchange one stock for another, right? So I'll have a good idea, I'll sell one of my companies, and I'll buy another. That's sort of what I did the last time I updated you guys when I thought Apple was way overvalued. I sold half of my position and then put it into CrowdStrike. That turned out to be a really good idea, at least so far. But generally speaking, I don't hold cash for long periods of time. Now, to answer the question, why cash? Now, there's a few reasons. So I get paid every month, right? Or bi-weekly or whatever it is. I've got a couple of jobs. And so cash has been slowly accumulating over time since about early April. Now, why has this been happening? I've had some life events. I was out helping my grandmother and my mother with some stuff. I got preoccupied with other things. There's more important things in life than money. And so we had that massive 15% correction. I didn't make a video about it. I was busy. And there were some opportunities at the time that I wasn't able to take full advantage of. However, I didn't have that much cash. I had probably 0.5% of cash at that point. So really, as the market continued to go back up, that's when, probably this last month or two, is when most of the cash has been coming in and sitting in my account. Now, that's okay. I think that, especially as a retail investor, I don't get paid to sit down every day and make YouTube videos and tell people exactly what I'm doing with my account, and nor do I get paid to manage my own portfolio, so my incentives are elsewhere. But this is just sort of a reality that we have to deal with. Someday you might get preoccupied and you won't be able to, stay up on the market news or whatever it is. So life happens. Life sucks and then you die, and here we are. But I've been getting back into it over the past month, and just seeing my portfolio go up and up and up has definitely felt good. But unfortunately, the big names that I absolutely love, mainly NVIDIA and CrowdStrike, have just been exploding to the upside to such a degree that I missed the opportunity. And part of it was I missed the opportunity with a little bit of my cash. Probably 10% of my cash could have been deployed at really good prices. But the other 90% I got after the fact. CrowdStrike was already up well above 400. I didn't feel like it was a good place to buy in at that point. And so, the cash that I kept accumulating was just sitting there, mainly because I felt like my companies that I love the most were way too expensive to buy more of, because that would increase my risk. So because these valuations were a little bit overstretched, I just kind of wanted to keep cash in reserve for when inevitably there is a pullback, when I do feel more confident with the price, or find another company with a better valuation that I can put it into. Now, once again, here's my disclaimer. I am not an investment advisor. Pause the video, read the disclaimer. I'm just a dude telling you what I do with my own money. I'm not a dude telling you what you should do with your money. Don't sue me. Now, I actually want to go back in time a little bit, back to April. I made this slide back then because I thought I was going to make a video, but then, life happened and I didn't have enough time. But this was essentially at the market bottom when I took this screenshot. This is my portfolio balance over time. And I took this screenshot essentially at the market bottom when we had that 15% drawdown. My account value was down significantly at that point. And if you watched my previous videos, you'll know that usually my lifetime CAGR is around 30%-ish. And so for this to see my lifetime CAGR drop down to 25%, I was a little bit sad. But, whatever. A market correction is going to do that, and it's just something that you have to roll with. So despite that, the S&P 500 CAGR was down to 10.4%, so still I had been 2.5 times the returns of the S&P, so it's kind of hard to sneeze at that. Here's the important thing about this slide, though. Back in April, when there were a ton of institutional investors, maybe some retail investors, but mainly institutional investors, just selling their shares on the news that Trump is putting 100 and some odd % tariffs on China, which is understandably bad. I'm not saying tariffs are good, but yes, that is a bad thing. However, we need to look at the bigger picture. We need to have faith in the U.S. economic system. We need to have faith in our global leaders. And we also need to have a very long-term perspective on what's going on with our portfolios. If you have selected companies that can't weather through tariffs and I don't even know, whatever mumbo jumbo that you can throw at companies, if you did not select companies that can weather through the storm, that's your fault, man. All the companies in my portfolio could weather through whatever tariffs that Trump or whoever else could throw at it. So I was confident. Obviously, I don't like seeing my portfolio drop by 30%. That's not a fun time for me. However, I wasn't scared. I really wasn't that scared. I was just riding the wave. And I think the testament to a good investor is your temperament in trying times, right? What are you going to be thinking when the market drops by 30%? If you can't handle a 30% drop or more in 2022, I think my account dropped by 50 or 60%. If you can't handle that, get out of the market, go into ETFs, buy VOO, buy VTI, and you know what I mean? But that's not me. I want high beta. I really want risk. I really want the returns that come with that. And so I kept moving forward. So the lesson is, don't worry about these little dips, even if it's 15%, even if it seems like the end of the world and President Trump is going to make terrible decisions. You have to have faith. You have to have faith. And if you're not convicted, I'm not sure why you're in the stock market. Now, this is my performance at that market bottom. I had dropped nearly 17% while the S&P was down 10%. So not quite at the bottom, but we were almost there. And clearly not having a great time. I was underperforming the S&P by 7 percentage points. Whatever. But now let's jump to today, right? We were somewhere around here in that screenshot, you know, and we are cruising up, skyrocketing up. I mean, it really is insane. So the lifetime CAGR as of yesterday's market close was 31.1%, whereas the S&P 500's CAGR was only 13.9% from January of 2019 until yesterday. Dude, this is why I love the market. It's just kind of fun, and this is also sort of a V-shaped recovery that we've had that nobody was really expecting. But at the same time, just given the history of the market over the past couple of years, it feels like every single recovery that we have from a correction, from a sell-off, whatever it is, it's always V-shaped. And that's insane to me because I feel like a lot of older investors who have lived through, the 80s, the 90s, the dot-com bubble, right, 2008, that V-shaped recovery was not always there. And I feel like for younger guys like me, I'm only 24 years old, guys who have been in the market for only the past maybe decade or two very much are used to these really quick snapbacks, and this is just another one of those. So, you can debate whether we're always going to have a V-shaped recovery. You can debate that all day long, but at the end of the day, what I'm seeing here is it feels like every single recovery we have is V-shaped, and it's extremely quick, and you can't miss it. And so this is one of the dangers of holding cash. This is one of the dangers of selling your stocks, especially as the market keeps dropping, because you never know when it's going to recover. You never know when the news is going to change. You never know when the sentiment is going to change. And that's why it's so dangerous to time the market. You just got to sort of dollar cost average over time, buy companies that are fairly valued, and put money into those companies that can genuinely weather the storm well. If you buy quality companies, you really shouldn't be worried. Now, this year, we have snapped from, I think, what was it, negative 17% year to date to all the way up to 21%. My portfolio has returned 21% this year. It's been 6 months. That's nuts. That's crazy. And in that same time period, the S&P 500 has only returned 5.6%. So I'm doing pretty well, and I am very, very, very happy with the performance so far. We'll see if it continues for the rest of the year. Now, I want to go over my two main companies, which is NVIDIA and CrowdStrike, because those are the most important in my portfolio. The other ones are relatively tiny, and I really want to show you exactly what I'm looking at in terms of the valuation of these companies and why I've kind of held off on buying them and instead keeping a small but sizable, I'd say, cash reserve on the sideline, just ready to buy any dips. Now, for NVIDIA, this is a very large company, and it's very, very, very profitable. So I generally like looking at the PE ratio, the forward PE ratio, and the PEG ratio to see where this company is in terms of its valuation. If you look at the PE, it's at almost a 50. Not terrible in terms of the historical PE ratio of NVIDIA. I think when I originally bought NVIDIA, it was up in the 80s, 90s, maybe even above 100, maybe 100, 110. It was a couple of years ago. Now, the forward PE looks a lot better. Forward PE is 32-ish, but it's not as cheap as it was a few months ago. I remember NVIDIA was trading in maybe the 120s, 110s, and the forward PE was back at maybe a 25, 24, and that was a really attractive price. Because NVIDIA is already 50% of my portfolio, I'm not looking to buy it just whenever it sort of looks good. I'm looking to buy NVIDIA whenever it looks like a steal and I can justify adding to an already insanely large position to my account. If I am buying NVIDIA just at 140, 150, 160, if it happens, right? If it reaches 160, that increases my risk. I want to keep a really nice margin of safety on all of my NVIDIA shares, not just the ones that I bought a couple of years ago. I want to keep a good margin of safety on all of them. So, generally speaking, when NVIDIA is below $120, that's generally when I'm buying at least some shares. Overall, NVIDIA is a phenomenal company. Its moat stays extremely strong. Its data center revenue is growing insanely quickly. People love NVIDIA, and they should love NVIDIA. But I'm just not buying right now, and that's completely okay. I'm comfortable with that. And if there's a massive dip, if Nvidia falls below maybe $130, $120, I would consider adding more to my position. Next is CrowdStrike. This has had an insane run-up over the past couple of months. Year to date, CrowdStrike is up 44%. What? I don't think I even expected this. I got to look at my previous videos, but I think my price target for CrowdStrike was somewhere in the mid 400s, maybe like $450 or something like that. Sounds right to me. Maybe even less than that. I would not have guessed that CrowdStrike broke 500 this year, but here we are. What's really interesting about it is why CrowdStrike has done so phenomenally well, and it's mainly because it's seen as a very safe company. It's shielded from tariffs. So Trump was laying on all these tariffs, and people were like, oh my gosh, what company can I put my money into that isn't going to be economically affected by these tariffs? And what company is better than CrowdStrike, who provides cybersecurity, which, by the way, isn't really a choice. Like, you can't just come to work one day and say, all our data, all of our information, our computer systems, our cloud security, it's just not important anymore. I'm gonna remove cybersecurity from our budget. Like, that's the last thing that you remove from a budget, right? It's not really an option. It is a need that all of these companies have. So then if we go into a recession, if the economy is suffering, if corporate profits are lessening, margins are contracting, CrowdStrike's going to be fine because they're going to still keep getting paid. Now, maybe they won't grow the number of customers as quickly. However, they're still going to get paid, and that's why a lot of investors see CrowdStrike as this safe haven in times like this where Trump is throwing on 130% tariffs on China. That's why it's run up 44%. Now, because the price has run up 44%, that has also made it so expensive that I can't really justify buying it. I started buying CrowdStrike at about $260 to $270. That's cheap. That's like I've doubled my money from the shares that I bought all the way back in August of last year after the CrowdStrike outage. That's awesome. I'm so glad that they've performed so well, but at the same time, when I come to a company and I look at the fact that their forward PE is 130, which I don't really like using PE for this company because they're not highly profitable yet, but nonetheless, the forward PE is pretty high. But, mainly what I look at here is the price to sales ratio. And their price to sales ratio is a 30. It's a 30 with the forward price to sales being a 24. And this is really what I like looking at, the forward price to sales. I said in a previous video that my forward price to sales for CrowdStrike that I like to see is somewhere around a 17, less than a 17. For cybersecurity, generally, it's about a 10 to a 14. So anything below a 17 for CrowdStrike, I would be extremely happy with. But now we're all the way up at 24, almost 25. That's very high. That's very high. And now it's not Palantir level high, but I think Palantir's forward price to sales is something like, it's definitely above 50. It's very nuts. The valuation on this company is stretched, in my opinion, and I think that it should come down a little bit. I think inevitably the price will come down. We're sort of in a state of euphoria for CrowdStrike investors right now. It'll come down, and really when that price hits anything around 360 to 380, if it hits 360 to 380, that's when I'll be looking to add more to my position. Again, this is 20% of my portfolio. I really don't need to put more money into this. It's not required. This is already going to be a lifelong holding for me as long as the story stays intact. So I don't need to increase my risk just because I like the name. I need to like the company's story, but I also need to get my money's worth in terms of the price on the stock. And so right now, too expensive for me. We're going to hold off and wait. And who knows, maybe a correction will happen. Maybe it won't. Doesn't matter. I just can't justify buying even this most amazing company at this very bad price. All right, folks, that's pretty much all I had to talk about today. My portfolio is, skyrocketing. At least that's what it feels like to me. I'm holding on to some cash. I'll update you if I end up buying anything. But for now, I think I'm just going to kind of hold off and look for opportunities. Now, I think I'm going to start actually delving into some smaller companies, probably within the range of, $10 billion to $100 billion, maybe $500 billion. They're large cap stocks, but sort of the smaller of the large cap. I don't want to look at just the Mag 7. I want to look within the S&P 500 and see if there's any smaller companies that I can take advantage of. Maybe there's a forgotten company that I haven't realized. So, yeah, I'd like to start making videos on that, and stay tuned if you're looking to see exactly how I qualitatively and quantitatively analyze a company to see whether I should buy it or not. Anyway, thank you all so much for your time, and I hope you have a wonderful day.